Let me be absolutely clear about the state of the global financial system right now. We are standing at an inflection point, witnessing a systemic unraveling that the overwhelming majority of retail investors and even established institutional players have yet to fully comprehend, let alone price into their strategies. The metric that should be chilling every single person who holds U.S. dollar-denominated assets is the catastrophic and structural decline in the underlying value of that currency. Forget the minor daily fluctuations, forget the temporary bounces engineered by short-term market dynamics. The foundational slide of the U.S. dollar index, the DXY, is undeniable and signifies a profound shift in global monetary trust. Eric Sprott, a legendary figure in the world of financial realism, a name synonymous with identifying the deep mechanics of monetary failure, isn't just issuing a mild caution about volatility. He is sounding a 5-alarm warning about a genuine accelerating collapse. He highlights, specifically, an approximately 11% drop in the dollar index from its recent peaks, a rapid and severe depreciation that acts as a flashing red signal. This is not simply a currency correction in a balanced market. This is tangible evidence that the financial bedrock we've relied upon for decades, the very foundation of global liquidity and trade, is actively crumbling. And this recognition leads directly to the most critical, yet counterintuitive reality of modern investing. The single most dangerous position you can possibly hold in this rapidly evolving environment is the one everyone traditionally retreats to in times of stress: cash. For decades, the dollar has enjoyed an unparalleled position of strength, sustained by its undisputed status as the world's primary reserve currency and the sheer overwhelming inertia of global trade settlements. This power allowed the United States to run enormous deficits with perceived impunity. But economic inertia, like physical inertia, eventually succumbs to gravity and fundamental forces. We have collectively witnessed, particularly since the 2008 crisis, and dramatically accelerating post-2020, the injection of trillions upon trillions of dollars into the system through quantitative easing, unprecedented governmental deficits, and stimulus packages that dwarf historical norms in both scale and frequency. The established narrative, the comforting lie told by central planners, has irrevocably shifted from temporary inflation to a stark and terrifying realization that this monetary expansion is neither temporary nor reversible. It is structural and permanent. This is the precise financial environment where the fiat currency, the U.S. dollar, begins to hemorrhage value not slowly but rapidly, accelerating the rate at which your carefully accrued savings evaporate into thin air. The core conflict facing every investor today is predominantly psychological. When volatility spikes, when the stock market throws violent fits and geopolitical risk climbs, the default instinctive reaction for the average person is to pull back, to retreat to the perceived safety of the sidelines, which inevitably means holding cash. Cash feels safe. It offers immediate liquidity and a psychological absence of risk because the nominal number in your bank account doesn't fluctuate day to day. But this perception of safety is fatally, tragically flawed. We have entered a new and treacherous financial paradigm, where the primary risk is not in holding assets that exhibit price volatility. The overwhelming risk is concentrated in holding the currency itself. Sprott's thesis is crystal clear. When the fiat system strains under the unsustainable weight of infinite and mounting debt obligations, cash ceases to be the reliable haven it once was and rapidly transforms into a melting ice cube. The decay of purchasing power, the silent, relentless erosion of what that dollar can buy, is the true silent killer, far more insidious and destructive than a sudden dramatic stock market crash, because it operates in slow motion until the critical terminal point of lost confidence is reached. To truly grasp the profound severity of this accelerating shift, we must delve deeper into its origins. What forces were powerful enough to drive this rapid 11% depreciation in such a compressed time frame? It certainly wasn't merely a natural, healthy market cycle adjusting to minor macroeconomic data. It was the direct, inevitable result of consistent policy decisions that have fundamentally altered the global perception of U.S. fiscal responsibility and solvency. And a crucial, critical question follows. If the world, foreign governments, sovereign wealth funds, and major international institutions is demonstrably jettisoning or seeking alternatives to dollars, where precisely are those trillions in capital flight flowing? Understanding the destination of this mass exodus is not merely academic. It is vital, because that destination inherently defines the next great, protective, and potentially explosive investment opportunity for the well-prepared investor. Let us unpack the underlying mechanics of this devaluation. When Sprott specifically references the 11% drop, he is utilizing the DXY, the benchmark measure of the dollar relative to a major basket of competing world currencies. But the real, terrifying narrative lies in the raw M2 money supply figures. Over a period of less than 3 years, we experienced an explosion in M2 growth, essentially diluting every single dollar already held in existence. The Federal Reserve, operating under immense political pressure and trapped between the opposing goals of stimulating a structurally sluggish economy and managing a mountainous pile of government debt, has consistently chosen the path of least resistance, monetizing debt and printing more currency. This policy choice creates an unavoidable and exponential debt spiral. Every new dollar that rolls off the digital press inherently and mathematically lowers the intrinsic value of all previous ones. The 11% decline in the DXY is simply the global market finally recognizing, reacting to, and punishing this extreme and continuous dilution. It is the leading, most visible indicator of something much, much worse, a foundational and complete loss of faith in the issuer. Sprott adamantly stresses that this is not a sustainable trend, and for investors, it is a race against time. The breathtaking speed at which this devaluation is occurring means the critical window for strategically repositioning assets into safety and growth is closing with alarming haste. Sprott's unparalleled genius as a financial visionary lies in his unique ability to look past the superficial financial smoke and mirrors, ignoring the temporary news cycles, and focusing relentlessly on the cold, hard balance sheet reality. He understands, unlike many on Wall Street, that governments never truly pay back debt in real terms. They inevitably choose the easier path of either restructuring or, more commonly, devaluing it away through currency debasement. That witnessed 11% collapse is the devaluation mechanism operating in plain sight. This is not some temporary technical dip that will simply normalize as the market calms down. This is the beginning of a sustained structural trend where competing fiat currencies engage in a self-destructive race to the bottom, driven entirely by unsustainable inflationary monetary policies. If you are currently sitting on the sidelines, complacently believing that the world's central banks can miraculously manage a soft landing while the U.S. government owes tens of trillions and keeps printing to cover the interest, you are fundamentally misunderstanding the immutable mathematics of debt and the unavoidable reality of fiat currency mechanics. In this current, inescapable environment, cash is not an asset, it is a dangerous and rapidly depreciating liability. The great revelation, the undeniable climax of this foundational analysis, is the absolute and terrifying breakdown of the stability illusion that the financial world has operated under since 1971. We are witnessing the ultimate failure of a monetary policy reliant on unlimited, unbacked issuance. The direct and inevitable consequence of the dollar's severe depreciation is the immediate, non-negotiable transfer of tangible wealth from those who choose to hold purely nominal assets, cash, low-yielding bonds, and fixed-income instruments, to those who have wisely positioned themselves into real, tangible, and scarce assets. Eric Sprott has dedicated his entire professional career preparing for this very moment. The epical moment when a critical mass of investors finally realizes that cash, which promised stability and safety, delivers the harshest and most comprehensive volatility of all, the relentless volatility of guaranteed purchasing power destruction. The 11% collapse is merely the opening salvo, the initial alarm bell forcing global markets to accept that the very definition of money must structurally revert to what it has historically always been. Something scarce, something tangible, something that exists entirely outside the reckless, self-serving control of central planners. The debt necessitates that the money printing must continue, and therefore, The dollar's permanent structural demise is financially locked in. The danger of staying in cash is no longer a theoretical risk that we must speculate upon. It is a cold, calculated certainty based purely on the undeniable fiscal reality of the world's largest debtor nation. We have firmly established the foundation. The US dollar is in accelerating structural decline, tangibly proven by its severe 11% drop, and holding fiat currency guarantees loss of real value. The burning, immediate question that dominates all serious investment discussion remains: how do we successfully escape this massive trap and protect the wealth we have worked so hard to accumulate? In the next part, we will pivot decisively from identifying the problem to detailing the precise, actionable solution, outlining Eric Sprott's specific roadmap for protective and profoundly profitable investment, deeply analyzing the hard assets that are structurally designed to thrive when fiat currencies fail. Stay tuned for part 2. I want to bring our focus now from the diagnosis of the problem, which was the unprecedented 11% collapse in the dollar's purchasing power, a collapse most people don't even recognize because it's masked by nominal gains, to the absolute necessity of the cure. We discussed the illusion of stability, but what happens structurally when the floor completely gives way? I am telling you that 11% drop was merely the seismic tremor before the true devastating earthquake hits the financial landscape. It was the warning shot fired across the bow of every single person holding unbacked paper currency. The average person, conditioned by decades of comfortable financial stability, thinks in terms of slow-moving interest rates and manageable inflation percentages, perhaps 3 or 4% year over year. I and those who study the mechanics of currency debasement think in terms of velocity, the frightening speed at which purchasing power is actively being incinerated when the central bank is mandated to print trillions. If you are sitting on cash right now, convinced that you are being conservative or protected from market volatility, you are fundamentally mistaken. You are, in fact, participating in a controlled demolition of your own wealth. And unfortunately, the demolition crew just pushed the main plunger and initiated the final sequence. The stage is set, the backdrop grim and unavoidable. Governments worldwide, particularly in the Western Hemisphere, are functionally insolvent. They have accumulated debt piles that are so vast they cannot possibly be paid down through productive economic output or through conventional taxation. The only escape hatch, the single valve they possess to alleviate this pressure, is the printing press. Therefore, inflation is not some accidental economic consequence, some unforeseen consequence of a temporary supply chain snag. It is the mandated necessary feature of the current financial system, strategically designed to inflate away debts denominated in a currency they control. For the financial elite orchestrating this is the definition of a monetary checkmate. The true conflict that defines our current era isn't merely high consumer prices, although that is the symptom that hurts the working class the most. The deeper, more insidious conflict is the institutional lie that these problems are temporary, or transitory, as they like to label it. Every major central bank is caught in a trap of their own design, a Gordian knot tied with impossible interest rate policy strings. If they dare raise rates significantly, say, to 5 or 6%, which would be necessary to truly fight price inflation, they would instantly crash the housing market, they would destroy the leveraged corporate bond market, and they would trigger a financial depression far worse than the events of 1929. They absolutely cannot allow that. Therefore, they cannot stop printing. They cannot stop monetizing the debt. This ironclad fiscal necessity guarantees the acceleration of the dollar's demise, making the core conflict incredibly personal. It is you, your retirement savings, and your purchasing power, pitted directly against the infinite supply of fiat currency that the central authorities are forced to create. This brings us to the open loops we established. If cash is acknowledged as functionally toxic, and the stock market is priced for perfection, based purely on fantasy growth projections fueled by cheap debt, where exactly does one flee? Where is the refuge? And perhaps more critically, why is this specific crisis fundamentally different from every other market correction or cyclical recession we've experienced over the last 50 years? The profound, definitive answer lies in the unique, unchangeable characteristic of real money, money that possesses inherent scarcity and that cannot be conjured into existence by a political directive. I want to draw your attention away from the distracting noise of the digital asset space and the leveraged paper markets, and towards the tangible reality of physical scarcity. Gold has historically been, and remains today, the ultimate central bank insurance policy. It carries no counterparty risk. It is not a liability of any corporation or government. It is a final store of value. But as a strategy for proactive capital growth during this period of debasement, we must talk specifically about silver, because silver holds the potential for truly explosive asymmetrical leverage. The gold-to-silver ratio is absurdly, historically high right now, sitting far above its historical mean. Silver is in a unique position because it is simultaneously a high-demand industrial metal, absolutely critical for every single part of the coming green energy revolution, from solar panels to electric vehicle components, and yet it is also a monetary metal, possessing the history and public recognition of money. The physical supply dynamics for silver are far tighter than most financial analysts realize or care to admit. We are witnessing massive physical withdrawals from major COMEX and LBMA vaults, indicative of institutional players recognizing the yawning chasm between the paper price and the physical reality. The financial paper market, where trillions in derivatives trade daily, is becoming increasingly, dangerously disconnected from the harsh reality of the physical market, where industrial buyers and sovereign funds are scrambling for actual bullion. This is the pattern interrupt. The traditional market models think silver should be cheap because of manipulated derivative pricing, but the physical supply chain is screaming desperation, showing structural deficits that cannot be covered by future mining output. If you are seeking genuine generational protection, you need something that cannot be printed by an insolvent government and, crucially, something that cannot be held electronically subject to potential confiscation, capital controls, or bank bail-ins, which are standard operating procedures during the end stage of a fiat currency collapse. The strategic move is to transfer paper wealth into physical density, reducing your exposure to the banking system itself. We must consider the rising cost of production. As inflation runs rampant through the economy, the cost of diesel, labor, and massive machinery required to pull metals out of the ground escalates drastically. This means the floor price for both gold and silver is rising rapidly, confirming their inherent value proposition against the backdrop of systemic inflation. Let me now re-engage the core theme and bring this back to the critical 11% collapse figure we started with. That number represents yesterday's acknowledged damage. Today's reality is that the dollar is accelerating its descent into the abyss, spurred on by endless quantitative easing and political desperation. Time is no longer a neutral factor. It is actively working against you. Every day you delay the transition from paper assets to tangible inflation-proof assets. The cost of acquiring real assets rises proportionally to the Fed's accelerating ability to inflate the money supply. This is not a patient investment strategy. It is a desperate race against systemic currency debasement. The great revelation, the fundamental truth that ties this all together, is not if the current financial system fails, but how the necessary reset will occur. The system can only run on debt and printing until public trust breaks entirely. When public faith in the dollar evaporates, which is exactly what happens when the majority of people finally realize their wages aren't keeping up, their rent is unaffordable, and the store shelf prices have doubled in a single year, the flight from fiat currency ceases to be a measured retreat and becomes an unstoppable stampede. This stampede is the hyperinflationary spiral. The closing loop, the ultimate payoff, is simple and undeniable. The only viable, globally recognized way out for governments to stabilize their broken financial structures after the currency collapses is to remonetize gold, or at least acknowledge its stabilizing role as a reserve asset. Historically, this is how currency regimes reset. The smart money, the hedge funds, the sovereign wealth funds, and the informed investors are moving before that institutional acknowledgement, that definitive political pivot, happens. They are front-running the inevitable return to hard assets. This strategic pre-positioning completely validates the core philosophy espoused by seasoned investors like Eric Sprott. Wealth protection must be rooted in scarcity. the choice that confronts you now is stark and immediate. You can choose to be a passive casualty of inflationary policy by clinging desperately to increasingly toxic cash and paper assets, or you can secure your financial future by transitioning judiciously into tangible, immutable wealth that has stood the test of millennia through every single prior currency collapse. The greatest risk in this environment is no longer in market volatility. The overwhelming existential risk is in the perceived safety of centralized, manipulated, and infinitely reproducible fiat currency. Do not wait for the confirmation headlines. Do not wait for the moment the evening news finally admits that the dollar is permanently broken. Begin the immediate strategic process of wealth diversification into physical precious metals today. Research the unprecedented structural supply constraints on physical silver. Understand the true rising cost of mining gold. Position yourself defensively, proactively, and heavily into these tangible assets, because the economic winter is already upon us. The blizzard is raging, and the storm shutters must be secured immediately. This is not a theoretical exercise in financial theory. This is a directive for survival.